Okay, we're at 10 o'clock. Thank you, everybody, for joining as we roll out our 2024 National Land Values Report. This is a fun project for us every year. This is our fifth year doing this. So we're continuing to refine how we want to present the data and kind of roll together what we're learning from the land market. So I'm Dave Muth, Director of Capital Markets here at People's Company. On the webinar with me are Steve Brewer, the President of People's Company, and Dr. Bruce Sherrick, the Director of the TIA Center for Farmland Research at the University of Illinois. We really enjoy going through the process of getting this report together every year because it allows us to connect with the folks across the country working in the local markets and to give everybody just a little bit of a perspective and update on where we're at as People's Company. We are actively working in 35 states now. We have completed some acquisitions where some new offices will be joining this list of offices that you see in this map. And we've deployed the full set of farmland transaction and management services across those major ag regions in the country. So our brokerage and auction business is doing over $1 billion a year in farmland transactions. Between our land management and capital markets group, we've got a little over $4 billion in AUM that we're working across the country. Our agricultural appraisal group is doing a little over $1.5 billion a year in assessed value on appraisals. And then our energy management and crop insurance business have become really important for us to be able to offer that full service and be able to help our clients across these different regions be able to deal with a lot of things that are coming at them. And crop insurance, Bruce is certainly going to give us a little bit of an update. That's certainly fundamental to farmland values and one of those core businesses from the perspective of making sure that we're deploying practices correctly across the country. So I want to hop in and just start with a little bit of a thematic change that's come out in 2024. So the previous few years, the real conversation has been around that changing cost of capital and the inflationary impacts on the farmland market. And that's been pretty consistent. And farmland, as I'm sure we all know, has very consistent sort of correlations and reactions to these factors. We kind of see a little bit of a change now, right? This makes it a little bit more difficult. There's a general theme of uncertainty around a number of different criteria that are impacting farmland. And so we're going to talk a little bit about net farm income, how that can be impacted by the tariffs and trade policy dynamics that we have some signals around, but don't completely understand. Certainly the Farm Bill conversations are ongoing, and there's quite a bit to get figured out on that front as well. And then when we start thinking about renewable fuels and some of the renewable energy policies, funding streams, et cetera, how is that going to impact where we're moving going forward? And then we do want to talk just a little bit about the private ecosystem service markets. And I'm going to start out with just a little bit of a conversation right down that lane. So each year, we're trying to make sure and communicate some of the interesting things that we're seeing that we think will have an impact on farmland value and farmland revenue streams. In the last couple of years, we've had a pretty keen focus on this low carbon energy transition, and we've kind of laid out with some scenarios what is the potential impact of this greening of the energy network and how that can create additional revenue streams to farmland. And there is uncertainty from a policy standpoint, as we mentioned, going forward on that front. But we continue to see it every single day with landowners getting engaged by developers and having different project opportunities emerge. And it's very core to our assessment of value on assets and long-term strategies on assets going forward. we see an interesting opportunity emerging with some new ecosystem service business models. And this is a fairly deep conversation, so we're just going to hit on a few key points to try and give some perspective on what we're excited about and what we're seeing going forward. So the first thing is to sort of clarify how we want to break this down and how we need to think about it. Because when we talk about ecosystem services, for a lot of us that work directly in ag, it feels like we're trying to create value and create revenue out of things that haven't had those transactional values previously. And when we start to break this down, we can get a little bit better perspective on how this may play out going forward. So just thinking about the services, the ecosystem services provided by Farmland. The provisioning services are that food, feed, fiber, fuel, and energy, those core sort of foundational elements of creating value in agriculture. And we all get that. The markets are well established. That's what we're focused on maximizing and have been for a very, very long time. We also have regulating services, and this is about how farmland participates in air quality, soil quality. Obviously the carbon conversation from a sequestration standpoint has been pretty significant, but thinking about flood mitigation, right? And the water quality story, right? These are important characteristics and services provided by Farmland where we're seeing opportunities for capturing value. And there are some emerging public and private markets and programs around these services. Supporting services really gets into that habitat and biodiversity conversation. So maintaining the ecosystem, right? And having farmland really perform within that habitat biodiversity arena. And we do see opportunities for capturing value here. It tends to be fairly project-based. And then the cultural services side of this, the recreation story is pretty fundamental to what we do. There's a lot of folks, certainly on the call and certainly within our organization that are familiar with hunting and other kinds of recreational leases. We also see some growth in the agritourism industry and just some of this engaging the land across the population, that there's some interesting value creation that we're seeing coming down the road there too. So when we think about these services, it helps us kind of get our mind wrapped around where value can come from. Now, why is this interesting now? There's a few factors that have really brought this to the forefront. This story of increasing caloric consumption globally has been around for a long time. We have to continue producing more with less. And then at the same time, the consumers, shareholders, and regulators across the globe are putting some more constraints on supply chain performance, right? And this has resulted in some significant commitments from CPG companies around meeting goals with their supply chain. Essentially, it's starting to unlock capital, moving towards recognizing value in these ecosystem services. On top of that, we're also seeing a little bit of a shift in the conversation, and I think Bruce is going to talk about this a little bit more as well, where agriculture was a kind of a problem within the climate change discussion to being more part of the solution. That also is sort of unlocking capital. And then on top of it, we do see a lot of advances in our ability to measure and quantify these ecosystem services with remote sensing and much less intense and much less expensive kinds of measurement techniques. These things are coming together to where we see a confluence of factors that are kind of starting to unlock business models that could be interesting. So really quickly, just kind of emphasizing that we see transactional value across ecosystem services today. This is just a very simple kind of idealistic scenario. It's 160 acres, quarter section. Let's call it kind of a Midwest Corn Belt, plains sort of asset. So 150 acres is tillable. Maybe we've got some grass waterways in the example here. Our asset value, we'll just assume at $12,000 an acre and a $1.8 million total asset value. There's several programs and opportunities to capture revenue from ecosystem services today. We've sketched out just a few here. So the Conservation Stewardship Program is an example. So we implement enhancements around practices, nutrient management, integrated pest management. We're reducing some tillage and we're using some cover crops. The particular payment rates are going to be different by state and the specific enhancement that's selected, but call it roughly $50 an acre for putting that suite of practices together. Okay, we also do see carbon markets that are available, right? They're largely undervalued in terms of, other kinds of carbon exchanges, but implementing those no-till and cover crops is kind of typical practices, may be able to achieve a $20 an acre payment. The CPG programs, right? So these supply chain programs relative to the consumer packaged good companies meeting their stated goals around ESG and sustainability. We see a number of practices. And again, it's going to be similar implementation of no-till and cover crops. And roughly a $30 per acre payment might be common for those kinds of programs. And then a very sort of common outcome is leasing hunting rights. And in this case, maybe we can get $10 an acre value across the whole farm for allowing hunters to come in and work the whole farm, focus on those grassland, the waterway and field border kinds of areas. So when we look at this sort of scenario, it creates real value, right? We're talking about up over $100 per total acre in additional value to the asset. We've got a few challenges, right? So some of these programs are very focused on delivering and engaging the farm operator as opposed to the landowner. So that lease agreement has to create value back to the landowner. But if we look at just roughly a 3% cap rate, and we said that this was an ongoing recurring revenue stream, that creates real value, almost $3,500 per acre. The problem is that these programs are fairly fragmented. We're working with 4 different organizations to realize this revenue stream in this simple case study, and the recurrence is limited, right? These programs are anywhere from a single-year lease on hunting rights up to maybe a 5-year program with CSP. Makes it very difficult to scale, and it's just not investable. So the key takeaway here is that we can achieve and are achieving value for ecosystem services today, but it's difficult to scale. Where we get into some new models that are pretty interesting, and I want to call out our friends at Intrinsic Exchange Group that have helped teach us a little bit about how they're putting this together and building out their natural asset company concepts, is focusing on this idea of natural asset accounting and finance, right? So if we step back and we start to recognize that there's value in all of these services that are provided by our land. And there's simple examples that we can get our heads wrapped around that make some of this connectivity. If you think about water quality as an example, it costs $150 per kilogram to remove nitrates from drinking water. So that creates real value on practices, whether that be management practices or structural practices back on the land to remove that nitrogen. We see markets that are available with wetlands. We've talked a little bit around supply chain capitalization of some of these practices. And so if we start with establishing that inherent value of the ecosystem services on individual assets, which is advancing quickly. There's still difficulty in making some of those measurements, but we apply some of the standard methodologies. Then we move into the notion of aggregating those assets and licensing the rights to the ecosystem services within the structure of a natural asset company. It gives us the opportunity to go raise capital against that natural asset value of the licensed rights. And this creates an investable structure that can engage some of the larger capital providers that are needing to play in this arena and really are trying to drive capital into this arena. Then you can utilize that capital to enhance the ecosystem services. A couple of examples would be regenerative practices, helping fund transitions to more regenerative practices, implementation of additional structural practices, whether that be things like bioreactors or wetlands, or other kinds of buffer strips. That capital gets utilized to actually accelerate and enhance the delivery of the services. And then you start to realize some of these revenue streams and the increased natural asset value for the shareholders in that NAC. And this is interesting. It's early in the process of trying to see how this can scale within production agriculture, but it matches the structure of the capital that's aligning to try and deploy into this arena. And so this is one that we've got our eye on, that we're really interested in watching how this works going forward. And so what I'm going to do is turn it over to Bruce to give us a bit of an update on what's happened with land values and the land market, what everybody actually really came to see here today.
Thanks, Dave. And welcome from my perspective to everybody on the webinar today as well. We've done this, as Dave said, for 5 years now. And I want to point out that about 2 years ago, we really focused on interest rates because we had just come out of the pandemic and we'd started a period of time where the markets were kind of had some interventions. And there were some impacts in both real asset markets and so on from that. And that was a pretty easy conversation. And then last year, we focused on inflation. And frankly, that was a pretty easy conversation too. We knew that things would somehow eventually calm down a bit. And this year we focused a little bit more in the presentations on income. And to be honest, that's a lot tougher to predict. Dave just spent some time talking about some of the new potential sources, but we want to take a little bit higher level view in the next 20 minutes or so and kind of do the land markets update. But a couple of other things just to point out. The full report will be made available. We'll send out a link after the webinar. It looks like I'm going to move here one forward just to make sure it's all working well. Is that working okay, Dave?
Sure is.
So, okay. We have a little technical glitch here, a little flash on the screens here. We'll send out a link after the webinar to get the full report. The full report has 8 or 9 sections where we detail the major impacts that are different in different parts of the country. So the Pacific Northwest, for example, has different pressures than the middle of the country. The Southern Plains have a different set of pressures and so on. But what we want to do in the next 20 or so minutes, as I said, have a conversation about what we're seeing and kind of bring this to the surface because, and guys join in here, I would not be lying if I said we'd spent more than 100 hours talking just through what we think is happening in the farmland markets, and we kind of use each other as that source of truth to bounce ideas off of and make sure that we're seeing things in the same way. And we'll have some thoughts at the end, kind of a back and forth on things we might see the same and might see differently. But each year we start by just saying, what do we have? This graph that you see now is the current cropland values as estimated by USDA. There's a little bit of fill-in process that we use at the TIA Center to make sure that all the agricultural areas are represented in a consistent fashion. But this is the annually updated, it's kind of a mid-year effect. So if you think that this is a little bit trailing, to some degree it will be. But a mid-year update of what we think cropland values are, and then we adjust it into the end of the year. And a rule of thumb you might think of that's kind of consistent is if you took the USDA definition of a farm, which includes very small scale operators, kind of hobby farms, things that you wouldn't expect to be commercially viable, and included those in the survey, it kind of brings the average values down. So if you took all these numbers and multiplied them by about 1.5, you'd kind of get back to what you would think of as high quality market values in those locations. But in fact, these numbers are collected in a way that's very, very consistent. So we can estimate rates of change, rates of return. We have property tax information. We have expenses that we can pull out of this and come up with actual returns. But I think you wouldn't be surprised to see that some of the high valued lands are in California, where a lot of things are produced and a lot of high value things are produced. Florida, primarily because of the extra pressures from populations. And then kind of in the heart of the Corn Belt. Moving forward a slide, if we just looked at the percentage price changes from 2023 to 2024, we get numbers that are a little bit surprising. These are not inconsistent with the other data sets that we do use, and we can, verify it and validate it in lots of different ways. But these numbers of, 3 or 4% in the middle of the country, 3 or 4% western coast, and then some higher numbers are just the annual appreciation portion. If we look at the 4-year average, and again, remember that in 2020 and 2021 and 2022, we had just some skyrocketing values, and we had reasonable incomes in the middle of that as well, which becomes part of the theme later on when we talk about things supporting the current land market. Farmers have pretty good balance sheets and still haven't worked all the way through that. But this 4-year average return, kind of want to focus on that rather than a 1-year average return. We'll get to the 1 year both by state and by region. But if you look at this again, it's quite competitive and it's relatively stable as well. So these numbers, if we slid this 4-year window from 1970 all the way to present, and the report does a little bit more of this, so you can look at how variable things are, compare it to NACREIF numbers, compare it to equities, do things like that. What you discover is that farmland has a couple of characteristics that are still remaining. One of those is high correlation with inflation. So when inflation was kind of ramped up post-pandemic and inflation, after the 80s, each of those periods of time, we find out that farmland is a real asset that captures all of that, plus nominal changes, and then return kind of income capitalized back into the value. Moving on a little more quickly here, the long-term rates of return. So this is from an investor perspective or landowner perspective, not from a farmer perspective, but if you include the cash return, subtract out the property taxes, subtract out the management expenses, and look at it as a percentage change of prior value, the average rates of return are really quite compelling. There are some regions of the country that are harder to access these returns. So, we always joke that we go to these presentations, talk to the potential investors, and, it's a high alpha kind of asset. So lots of excess return, good inflation hedge, very stable, very, very infrequent drawdowns. And all the features as an investment look great. And then you kind of get the, slow clap from the back of the room. Gosh, how do we buy this? And the answer is, well, you can't. I mean, this, we'll talk about the turnover and how you actually access the returns kind of later in the presentation. It's a very high touch asset to acquire and to manage and to dispose of. So these returns are very attractive, but you have to have a very dedicated and intentional mechanism to get access to the returns. That becomes one of the themes I'll talk about at the very end, about what is changing in these markets is the ability to do that. The informational systems and the ability to touch and tap and click on a piece of property and know a lot about it. It's something that we couldn't have done 5 years ago at the level we can do today. And Dave and Steve, don't let me just get totally long-winded here. These are things we spend an awful lot of time trying to build and trying to figure out how to do. So join in. Kind of the summary slide that I think substitutes for what we typically do. Historically, we'll kind of walk around the country and talk about, each of the particular regions and what's affecting them. This year, I think it's easier to just do the summary. And this is through our estimates through the end of 2024. So each year when USDA releases their data, they update up to 2 or 3 more years in the past. And so these will modify a little bit, but not honestly all that much. And then the bottom 3 rows on this slide are for NACREIF. And NACREIF is the largest total reporting system for institutional owners in the country. 16 billion or so, fairly large properties, all managed with return-seeking intentions. So these are good data at the bottom. And what you'll notice is that permanent croplands have really struggled in the last 5 years or so. And that's because the NACREIF members are, in a sense, overweight relative to the total production economy, overweight some things on the West Coast that had particularly problematic responses when the pandemic started on prices or to export market access. And so I expect those to come back. If you look to the right, the long-term returns, NCREIF 25-year, 30-year, 35-year, even the 15-year have pretty compelling high returns. So I don't want to, look at the first couple of years and say that's too much of a bash on it. And annual cropland or row cropland, or what you would think of as corn and soybeans, of course, in the middle of the country primarily, 8.6 in the last year, as of third quarter 2024.
Bruce, one thing that is interesting that's a takeaway when we've kind of tinkered with this data that's perhaps useful to point out, when you start to look at some of the stability of returns, right, and relative to a lot of investments, right, if we're taking that investment thesis kind of view towards these farmland numbers, they're all pretty stable, really. But even the tighter stability, you can start to call out those regions where you have a little bit more diversity in crop production. And the Pacific Northwest kind of jumps out, whereas, say, a corn belt, you can see a little bit of a tracking along some of those commodity cycles. That's an interesting takeaway for folks that are thinking about farmland and putting portfolios together and where they might want to be.
Absolutely. There's a nice table that we've developed that is sort of the maximum drawdown in any given year over the last 35. And again, in stocks or in an individual company, you might have a 30% or a 50% or, .com kind of bust and boom things. And in farmland, you almost have zero negatives even. And the minimum drawdown as a fraction of the long-term return is so small that it becomes an incredibly attractive asset for folks who maybe don't need to consume the income, but want to have long-term capital appreciation. There's, of course, a tax advantage to that. Or otherwise want to have exposure to inflation, but don't need to have, again, the annual income be that high. So kind of like holding something that's inflation hedging, but getting a coupon at the same time. This is a kind of a movement then into what we want to talk about and just give a sense of where income comes from, what the sources are, and then help explain what I think a lot of people probably have in their mind, which is, gosh, this looks a little too rosy. I thought, farmers were having a tough income year. You see the USDA numbers and the popular press and the calls for additional farm support that are coming out of the farm press right now. And we'll make sense of that in just about 3 or 4 slides, because these are the total receipts, first of all. And that's both crop and livestock. And again, California is really, really critical because of the high valued crops, the tree nut crops, the 2 major production valleys with fruits and vegetables, and mid to Northern California with some wine grapes and high valued areas. So that's real, both because of the size and because of the very unique, collection of microclimates that lead to things you can really only grow in California. Hard to grow pistachios in Illinois, for example. Texas, likewise, just plain huge. And Texas has a unique feature in that there's so much grazing land that has oil or energy or other sources of income that support the land, and the land is difficult to separate out from its agricultural use. But you do have some different kind of movements there. And then when we get to livestock, of course, Texas is also really rather critical. But as you can see here, Illinois, Iowa, Indiana, the middle of the Corn Belt, Nebraska, Kansas, kind of the plains where there's slightly lower valued but slightly more livestock, gets us into the situation where we can look at what led to the changes in income through time and how is that distributed across those numbers we just saw. Now, this is expressed in constant 2024 dollars, so we don't have we've taken out the time trend that, if you went back to 2004, price levels, in fact, were different. And the orange line is kind of the net cash income, the dotted line is average, the blue line, net farm income, making all the non-cash adjustments to get to what a farmer might think they could actually put into or take out of their balance sheet accounts. And again, it doesn't look that bad, right? So it's above its long-term average. But we keep hearing things like it's off another 30 million, it's off another 50 million from the high points that it experienced in 2021 and 2022 in particular. Well, that doesn't tell the whole story, because the income has some features in it that are really hard to manage. One of those is that the expenses, seed and fertilizer in particular, that became more expensive when farmers' incomes were higher, haven't mitigated quite as much. Likewise, the direct government payments and the countercyclical government payments, even though those dotted lines don't look nearly as high as the revenues and the expense lines, away from zero, remember that those move directly into the bottom line. And so in 2020, the purple dots, which were MFP payments and other things related, and on through 2021, some COVID related payments, those are actually very, very significant numbers and actually explain a big part of the difference from the long-term trend. And this is the first time this has ever happened. In 2024, animals and livestock products, so dairy, cattle, hogs, chickens, pigs, turkeys, exceeded in terms of receipts crops for the first time. And so this is a major change because when commodity prices go down, feed prices for livestock also go down. It becomes a lot cheaper to grow out a 6-pound chicken. It grow out a hog or a steer. And so this return of cheaper feed, and we haven't fully reversed the increased demand that we got during the pandemic for food bought in grocery stores, brought home, and that food has a higher share of the dollar go back to the original producer than if you were to go buy that steak in a restaurant instead. So again, just recognizing that, wanted to sort of pattern out where the crop, livestock, and total farm receipts correlate pretty well with final income. This is the total again, and you'll see that California, Iowa, Texas, middle of the country, really, really dominates, but the pattern is really kind of interesting. If you look at the green shaded on the right, the furthest right, green 59, 39, 32 correspond directly to the numbers in the chart. But if we separate that into crop production, you see the middle of the country, Illinois and Iowa in particular, and California still remain really critical, but Texas kind of drops off. So it doesn't have as much exposure to the reduction in revenue that came about from reduced crops. And Illinois, by contrast, if you just look at the shading, doesn't have as much livestock left, kind of pigs left Illinois for Iowa quite some time ago. And you'll see that demonstrated here in the value of livestock. Georgia pops back up, the Carolinas, a lot of chickens on the East Coast, some pork production that's really being concentrated there. And these are having differential effects in supporting farmland values. Moving forward again, just to keep this conversation moving quickly so we can get into the more fun back and forth. The other thing that I think is pretty critical to understand is the impact of very, very thin markets. In 2021 and parts of early 22, I think if you were a broker, that fourth quarter and first quarter felt like it was pretty easy to be in the farmland market, right? You could access a whole lot of transactions. It was high values. Things felt pretty simple. But I want to point out that the transactional volume, even in its best years, is really pretty tiny. At 2%, that means that on average, land is held for 50 years before it turns over. At 1%, it would be 100 years. So you can sort of do the math. The reason this is in two different, there's a technical reason we have the first period in blue and the second period in orange. We get all of the data from Department of Revenue and can do all the transfer declaration summaries. There was a bit of a change in 2011 on how we could collect the data. And to be honest, the blue line or the orange line, they're both right. They're just on a slightly different definition of what was agricultural use. And so we screen these to be arm's length and taxed as agricultural land both before and after the sale. And so if you move the orange up to get on a consistent basis with the pre-change in the form, or you move the blue down to get a consistent number, it's still just barely over 1.5%. That thin market effect, we talk about a lot about, the value of farmland. Well, there was a $22,000 sale in Douglas County, and what did it mean? It meant that the two neighbors really wanted it. But if you were to say, what's the value of all the land, rather than just the top end or the bottom end, it's a more meaningful way of looking at the question. And again, I'll leave this slide up while I tee up the conversation that Dave and Steve will want to join in on. But when we saw the markets run up in value in 2021, 22, and kind of taper off in 2023, at the end of 2024, you hear a lot of comments about, oh, the top end's off 10 or 15%. And gosh, we're just not seeing the same sales values. The middle of the asset quality space, was turning over a little better, and the lower quality or B quality land was actually still holding its value pretty well. So on the way up, the prices among qualities kind of fanned out. And on the way down, the quality convergence, if you will, in terms of rates of return, made it look like the values at the top end were coming down by more than the values of land at the lower quality. And again, the regional reports, encourage everybody to download the report. We'll send out a link to the attendees after this is all done. Has detail down to the state level for each of the regions and talks about this in a lot more detail. But the convergence is really critical, but thin markets are also very, very supportive, because in addition to just capitalizing the income that you expect and treating it like a pure financial market, you also have to think about farmers that are adding to their operational base and growing and diluting fixed costs and may have a one-time chance to get the land that's closest to them. Institutional buyers, of course, favor much larger tracts, and one of the reasons that the Delta in California are favored by institutional buyers, you can get bigger tracts. But this assembly of an efficient asset class is something that is really influencing the market more and more. This is just kind of a filler slide before we get to some conversations about other things, but wanted to point this out to say why, frankly, it was easier for us the last 2 years to talk about the major forces in farmland. This is a long-term chart back to 1970, where the dotted line is the 10-year Treasury rate, and the blue Illinois, black Indiana, yellow Iowa, and red Minnesota, closest we could come to football team colors. Just the 4 states that we have a really good handle on in terms of transactional values on almost a daily basis. The only time you got this divergence, this massive divergence between prices and what was implied as the fair price through this sort of capitalization argument I've been using, was in the 80s, when we had 18% interest rates and appreciation rates in farmland that were clearly not sustainable, but people were lending against those numbers anyhow. And then for the next 30 some years, we essentially tracked really well. In 2008 and 9, when we started managing interest rates down, and in 2012, when we had a massive drought, what we noticed is that the farmland markets remained rational, no matter what we did in the interest rate markets. Sort of those steadier lines, when we had interest rate management, farmland didn't just spike in value as a response, but we did add a little bit more leverage to the sector. Not a lot, though. It's always shocking for people who are not familiar with farmland to find out that it's a $4 trillion asset class with only 13% leverage, and on the land portion of that asset base, only 10% leverage. So farmland doesn't respond as much to changes in interest rates as commercial real estate and other things. And this is a chart that I wanted to include because we do talk a little bit more in the full report about the movement of farmland into portfolios where people who are like focusing on what you would call the alt space now, especially real estate, have really started recommending farmland be considered as well. A nice little stat from Forbes in the report about 10 to 15% of RIAs even knew what farmland was 5 years ago. Now 50% even occasionally make recommendations to include considering real estate. And that I'll jump into a couple of things that we think are really critical going forward. And this is where, again, don't let me get through a bullet point, guys, without jumping in on this. But first of all, if you've been following the press, we don't have a farm bill. And we usually don't have a farm bill right at the time that you would expect it to be scheduled. It's part of the, the standard dance. But this year, one of the things that was important to appreciate is that the farm bill debate before the election was not contentious on its normal kind of dimensions. Instead of saying it's a straight out, hey, what can we cut or what can we add or where we want to get some permanent funding in the baseline, it was really a subsidy war to see which side could could give away the most money, to be blunt. And we have a more substantial change in the House in terms of the membership of the Ag Committee. The House has about 50 or 52 members on the Ag Committee, and the Senate has low 20s. But we'll have an incoming change to Senator Bozeman on the Senate side. Angie Craig is replacing Representative Scott as the ranking member on the House side. The House side doesn't have as much influence, of course. But it kind of fell apart because they're waiting for the election to find out who would have the upper hand after the election to say, we're going to add more subsidy into the commodity titles and crop insurance titles and things that have a direct potential to transfer income rather than just mitigate risk at the farm level. And probably the increases in SNAP will be a little bit of the casualty set from this. And on top of that, the crop insurance subsidy expansions have been nothing short of monstrous, to be blunt. So we're now moving insurance subsidies up to 65% on products that might have a 95% coverage. The idea is that if you run a crop insurance program at a 1-to-1 loss ratio and you subsidized it, say at 50%, then every dollar you spend on insurance, you should get $1.50 back. Well, the empirical realities are that crop insurance really favors the South. The incoming presumed Secretary of Agriculture, Brooke Rollins, is a Texas A&M alum and a little bit more familiar with the South. Senator Bozeman from Arkansas, a little more familiar with the South. So I think at least, at minimum, it's fair to say that the only calls for forward support in agriculture tend to be, how do we get more to it? At the same time, you may have seen, if you're following farm press, the proposals from both the Farms Act and last week's conversation about adding another 30 billion or so total to the kind of farm support safety nets, direct payments for corn, direct payments for soybeans, direct payments for peanuts, rice, cotton. The list is rather extensive. That will get a little bit more pressure in this new approach of debating things that go into even the extended keep the government alive bill. Trade and tariffs, again, I know there's everybody has a very specific opinion on this, but we do have a very deep reliance, in particular in the soybean world, on what we export. About a third of the corn crop goes into ethanol, and we do export some ethanol. But those offsetting routes that you have to take soybeans through, if, for example, we enter a second trade war with China, what happened the first time is China then moved a lot of their purchasing to Brazil, and we ended up shipping soybeans around the country a lot further than they would have had to have been shipped. But getting access to long-term positive trade relationships is really critical, because increasingly we'll grow more food here and people will be other places. And so having the ability to take those comparative advantages into the valuation of ag assets is really important. At the same time, issues around farm labor and also construction trades. Lots of labor that's difficult to fully document, perhaps in dairy. A massive disruption of that at the same time we're running at fairly low unemployment can create a really big problem. I think those are concentrated probably on the West Coast more than in the middle of the country, but that's something to really pay attention to. And again, keeping with Dave's theme of the theme is uncertainty, the last rate cut of the year, last week, earlier this week, signaled kind of a higher for longer expectation from the Fed and was wrapped in a super hawkish wrapper, probably more so than people expected, the equity market responding commensurately with that. But how do we get out of this? Or what is the new normal? Or what are the impacts on farmland? Well, in general, farmland responds positively to inflation, but not necessarily to inflation surprises. So that's a complicated one to get the direction right. Also, the renewable fuel standards, related biofuels policies. Dave talked about some of the very positives from having access to more and more of the eco-service market kind of payments. And but I think it's fair to say the incoming administration will not be as favorable toward environmental-based payments and remainders in the IRA and other things not yet obligated related to climate smart ag, at least the emphasis will wane, and figuring out whether there's consumer demand for things like low carbon fuels or low intensity or decarbonizing the energy system. They're easy to talk about, but when the cheapest electricity still comes from natural gas, it's difficult to fully get the markets to stand on their own without some government subsidy. Finally, I want to make a big point of this last point, and then maybe invite Steve, who you haven't heard much from yet, to comment on how Peoples thinks about this too. This idea that information technologies or the ability to know more than somebody else is one of the new competitive advantages. Simply being a better farmer or having a better set of equipment, or those advantages have become table stakes. We can all access auto steer and yield maps and variable rate technologies now. Farms as small as the one I grew up on even. So the base table stakes of the technology are kind of there now. And genetics have gotten so good that we can grow things in parts of the country that maybe we didn't 10 years ago. But what we can also do now is say, gosh, NASA has a system for telling me what the total photosynthetic impact was of broadleaves versus grasses in this region after a rain event. Well, that's actually true, and figuring out how to make any money off of that is a little complicated. But getting access to the base layers of information, I think, has become a super critical, it will be a delineating or a defining, differentiating feature in competing for making good deals in farmland going forward. With that, I'm kind of done with my comments. We've talked a lot. We've kind of been long-winded here. But I think it's really important to then say, what do we know? What don't we know? How are we going to get to knowing more about things, and where do the markets go going forward? My closing, whenever I give talks about farmland markets and somebody in the audience will say, are farmland markets going up or down? I always say it's very, very easy. They're going up. I'm not going to define the time period, but in 5 years, I'm pretty confident. 10 years, very, very confident. 20 years, extremely confident. Next year, a little harder to predict. I don't think any of us would be shocked if we had some more churn in the market. What we are seeing, I follow Illinois most closely. What we're seeing in Illinois is some parcels that you never would have seen sell 5 years ago or 3 years ago or last year being brought to market because that's the date they were going to come to market because somebody died and you had an estate to settle or something like that. But the what I would call almost the voluntary or the opportunistic bringing land to market because the neighbor sold really high. Those transactions seem to be gone to me. So I think going forward, what I expect is an eventual slow return to the same turnover that we expect, a little higher than we have now. I think long-term values are going to keep creeping up, and there's an awful lot of support that prevents a major, major downturn. If we have some trade disruptions, monetary disruptions, inflation shocks, it's not at all out of the ordinary to expect a few percentage up and down. But crop insurance and other kind of subsidy effects are so strong now that I think the long-term operational risk has gotten to the point where it's a little easier to control. So with that, Steve, you haven't had a chance to chime in here and kind of add how you think about it from somebody who has to make money running a company doing all of this.
Yeah, no, appreciate the commentary, Bruce, and the big thoughts that you and Dave always offer. Iowa State University publishes their annual land values survey every December, and it happens to have come out this week. And, a lot of the numbers that you guys have aggregated here are the USDA averages and the NACREIF professionally managed farmland. And I think the Iowa State survey has been occurring since the 1970s, and they showed, a 3.1% decrease in Iowa land values over the last year. As you guys are thinking about land values, I think a lot of the folks on the call want to hear a number, like what's the land market doing and where's it going and where do we think it's going to head in 2025. And so I thought I'd provide a little commentary on the Iowa State land value survey showing that 3.1% decrease, because I think a lot of the things that you saw in the slides here, the land market, when you look at just commodity prices alone and when you look at interest rates alone, I think a lot of folks would have anticipated that land values would probably soften more so than what a lot of the survey data and the USDA numbers are showing. And so part of it is why aren't land values declining to the degree that maybe your spreadsheet might show that they would. And a lot of those themes are built into your slides here: ecosystem services, natural capital, wind and solar, carbon. There's a lot of themes that are being talked about around farmland. And as I think about our business, you can't be in the farmland business today if you're not talking about carbon and you're not talking about renewables. And so, you know, I think as Bruce talked about the 10-year horizon on land values, I think everybody on this call is incredibly bullish about where the land market's headed over the long haul. But in the short term, there's some adjustments happening around commodity prices and interest rates. And I was thinking back to 2013. That was the last time the land market had peaked, and then came off of that 3-year period of $7 corn. And I was reflecting on that last 10-year stretch as you guys were talking. Land prices also in 2013 didn't come down to the degree that a lot of people maybe would have thought, as you saw commodity prices get cut in half. And part of what happened there was, yes, rents went down in 2013, but your return expectation around your cost of capital went down as well. And so my back of the envelope math on that, and in that 2013 era, if you reduced rents by $50 an acre, but you also reduced your return expectation by 50 basis points, your land value effectively stayed the same. And I think one of the unique things about the farmland market is that it doesn't get repriced every day like the stock market does. And so when commodity prices change, when interest rates change, farmland prices tend to adjust more slowly over time. And I think that's what we're seeing in the farmland market today. There's a pretty wide spread. When people ask me, you know, what's the land market doing? You'll still see, in fact, this week there was several sales that were $20,000 an acre or more in the Midwest. But then for every one of those sales, you'll see maybe a sale that felt a little soft. And so trying to get your brain calibrated around where the land market is when you're getting these mixed signals around uncertainty in the market, I think that's what a lot of the folks on the call would be interested in all of our perspectives on. And so jumping into the current arena, comparing it to 2013, I think, you know, we've got that softer commodity price market, which might translate into softer rents, but we had such a strong yield year in the Midwest that rents probably aren't going to decline to the degree that one might have thought. But you're starting to see the exact opposite of the cap rate compression we saw in 2013. You're actually starting to see people slowly adjust their return expectations up as farmland now is competing against other fixed income like T-bills and CDs and money market accounts. And so, you know, using my example of the $50 rent decline, if you used a $25 rent decline today and you actually increased your return expectation by 50 basis points, you actually see a negative number of about 23% for farmland values. And so as I'm thinking about Iowa State's number of a negative 3.1%, and then that back of the envelope math, maybe an outside case of 23% down, what I'm seeing in the transactions that are coming across our desk in the Midwest right now is that the market's probably softened more than what the Iowa State survey would reflect. And we're probably seeing something closer to 10 to 15% decline in farmland values year over year, just on the transactions that I'm watching. So, Bruce or Dave, I'd invite you to add some commentary or debate a little bit some of those ideas.
Yeah.
Go ahead.
Go ahead, Bruce.
I was going to say, we're sending out our templates for the Illinois analog to that with the Illinois Society this week, actually. And it is difficult to figure out how to do a quality adjustment on that as well. And kind of what I put in my section for the middle of the country Corn Belt. Iowa, on the periods of time when land values increase, tends to increase 3 or 4% more than Illinois will. And on the way back down tends to decrease 3 or 4% more than Illinois does. And there's some reasons for that, but the spreading out if you will, on the way up is higher in Iowa than it is in Illinois and has been for decades. The high quality land is off. I was estimating 7 to 10% in Illinois and 10% in Iowa for the highest quality land. And the B quality in Illinois, say and SP, we have a different kind of productivity index, but like a 120 PI index in Illinois is actually up a little bit. So I think there are pockets. I think what you're saying for the the highest quality, the best stuff. I wouldn't be surprised to find out that the revisions are all in the direction that you said and of the magnitude. Also wouldn't be surprised that when you get those $20,000 an acre sales kind of refactored in, that the averages don't mean as much as they used to. I think the question is, if you randomly drop pins in a map and force those to go to sale, what would they be worth? That's the valuation question that I wish we could answer. I think there is an awful lot of long-term support. I think the new classes of money that are showing up, the high net worth individuals and the family offices, and the number of calls I get just in my role to say, hey, we really have been interested in farmland, but how do we get access to it? I think that's a pressure that's increasing to some degree because, as you said, the belief that we may be near the end of the bull run in the equity market and need to preserve some capital, that for the high net worth folks seems to be bubbling up as well. But Dave, sorry, kind of interrupted you. We also have a question typed in the chat.
Oh, excellent. So I'll come at this from the capital markets perspective, right? So we're deploying capital for investor clients, and it was challenging there for a solid 24 months to find assets that you really felt good about, because candidly things just felt really expensive, and that is unlocked. And so to your point, Steve, and then what you were highlighting there, Bruce, the transactional environment right now is fairly fragmented, right? We still have headline sales, and that comes down to, as you mentioned earlier, Bruce, right? The two neighbors that have to own it, kinds of dynamics that are still out there. But from an asset pipeline standpoint, when we're working hard to find good investable deals for our clients, it's a much more robust set of assets we feel good about right now than it has been. So it's pretty fragmented. And one of the things, Bruce, when your turnover slide where you were showing how much of the asset class is turning over in Illinois, it kind of brought me back, Steve, if you remember a conversation with one of the really smart farmland investors that we've worked with, has quite a bit of land across the country. And, that spike in 2021 and into 2022 that showed up in that graph, Bruce, he said he loves high land markets because it brings land to the market that wouldn't otherwise come to the market, right? And so that you kind of have a cascading effect here just a little bit when you get some of this fragmentation, where expectations around value are a little bit harder to pin down. That can lock up folks and slow down some of that transaction volume. And it's not obvious how that plays out over time.
Yeah, Dave, to chime in on that. So expensive land tends to bring more land to the market, right? Because you do get those opportunistic sellers. But when you have a market that is uncertain and you don't have predictability around bringing your farm to the market and setting a record high price, that tends to keep people from selling their land. And so when you look at the amount of turnover, and Bruce touched on this on his slides, if 1 to 2% of the market's turning over on an annual basis, and you have a perception that the land market's softened, because of the leverage in farmland only being about 12 to 13% nationwide, there's not forced sales, there's not distressed sellers, generally speaking. And so when you have this perception that the land market's a little softer, people just don't bring the land to the market. They choose to hold it. And then that further restricts the supply. So when you think about all the capital in the world, both farmers and investors who want to buy farmland, and this is a market right now because there's a certain segment of the population that believes we're going to have long-term inflation even higher than where we're at today, that believe that farmland is positively correlated with inflation. So they want to pile on and put money into farmland. Well, as you've restricted supply, you've got this capital coming in saying, no, I want farmland because of the inflation hedge, because it's not correlated with public equities. As that supply's restricted. And that's why I don't think the land market will actually come down to the degree that maybe your spreadsheet might show in my example of increasing your return expectation by 50 basis points and lowering rents by $25. Yes, in a spreadsheet that would suggest that land value should come down 20% or more, but I don't think that actually happens because the market is constrained by the supply.
So
You guys want to tackle this question in the chat on RFK and the proposed Make America Healthy, which is a great question.
It is a great question.
I think the question is around RFK and if we eliminate processed foods and seed oils, will that affect subsidies and general commodities and ultimately the land market? And this is one of those debates that Bruce and I actually enjoy having and might have different views on from time to time. But I do think this new administration is quite interesting, where you've got RFK with some pretty radical views around agriculture, negative on the pipeline, negative on biofuels, negative on big food processors in general. So you've got that dynamic. And then you've also got the Elon Musk dynamic of electric cars sitting there. And how this all plays out with a new farm bill and a new administration and these competing views within the administration, I think that's the uncertainty that we're talking about right now. Like you don't know what the rules of the game are, and so it's hard for people to make bets on big investments when you don't know what the rules of the game are. And I think it's going to be hard to have a widespread change in policy politically, but this is one of those things that keeps you awake at night when you think about 50% of the corn crop goes to biofuels or ethanol production. With the stroke of a pen, you could have a fundamental change in how farmland functions. And so when I think about the long-term outlook for farmland and Bruce's comment that I'm confident 5 years from now land will be worth more, and I'm completely confident that 10 years from now it'll be worth more. The only thing that would actually screw that up is if there was just a fundamental shift in policy. And these RFK moments do give you a moment to pause and think about what that could look like and how that could impact farmland values.
Yeah, I think we've all been in dozens of debates and conversations about things we don't know yet, and RFK is a lightning rod for one of those issues is true. There's a great quote. I wish I had thought of it first and I just repeated it, but it was, if politicians accomplished 10% of what they promised, there would be no need for a heaven or a hell. In this case, I think the comments I've heard from a couple of Washington insiders are, of course, you can't do things that consumers and large numbers of voters really, really, truly object to. And so making the debate broader, but getting a massive change is complicated. So it's easy to say, and RFK has said, hey, no more pesticides. We must all go, all organic. A clearly impossible proposition, right? So there are things that like point in a direction, and then there's how far in that direction you can go. And Steve is exactly right. We don't know how far you can go, and you don't know what people will do, and those can create a lot of additional volatility. I think the long term, consumers are incredibly sensitive to things, and food inflation being one of them. And that's a hard thing to write blanket policies around that don't have to stand the public perception test at some point in implementation. And again, we're still 30 or 40 days away from even thinking about hearings for confirmation. And, we don't know what we don't know. I think these are important things, as Steve said, that, drop bombs into the middle of a system that we thought we understood, and they can, in fact, create massive changes. The ethanol debate is really critical for farmers, of course, because again, maybe we're moving more of the soybean and oil market into biofuels, but corn is really solidly dependent on ethanol. But the secondary use for ethanol that's outside blended fuels is also not zero. And so at a good presentation, one of our good friends who's working more and more with us, Dave Chatterton at Strategic Farm Marketing, had a set of charts up on where demand comes from when prices of corn get any lower. And low prices cure low prices in the same way high prices cure high prices. So we're unlocking some additional demand, and I don't think we're going to make all of our corn into, packaging products or starch or anything like that, but it's also not quite as dire sometimes as people think, because big, complicated, heavy systems take a long time to change.
Bruce, let's talk about the asset managers and the investors in the space, and kind of that conflicting point of view that yes, farmland's not correlated with public equities. You've got the stock market at historically high levels, and you want to own farmland because of that inflation hedge. But yet farmland's now competing against fixed income, and a lot of our friends that are raising capital for their farmland funds are struggling to raise capital. Thematically, what do you think that institutional capital participating in the market, where do you see that going?
I think we all have to, get all 89 people on the call to sign NDAs before we talk about this, is what I think. It's complicated, but a lot of the money that's coming into the largest funds is coming from a currency play as well. So you have European money coming into certain funds, and you have folks who need a very long-term protection still being able to do this. But you're correct that the short term, the cash income from farming is not going to exceed the current fixed income. I think this is not, again, quite as dire a situation going forward, and it's harder to raise money and it's harder to deploy money, but those are also correlated for the funds. It's been hard with debt. So individuals, again, if we describe, have very low leverage levels. Funds, one of the models for funds, not of the large qualified pension funds, but of the REITs and the private REITs in particular, buy a bunch of under-levered assets, put them together and put rational leverage behind it, and then make your money on the multiple. Well, that model clearly doesn't work anymore when cash rents are under 3% and required debt service is maybe 6% or something. We have a question too. I'll just interject. Can we turn off the slides so we can see the speakers? We all decided that there wouldn't be cameras today, and so we're in different places and you wouldn't want to see the speakers. I'll just comment that.
Bruce, to jump in, and I've made the comment tongue in cheek a little bit that cheap capital created business models that don't need to exist. And I think we are seeing a little bit of that consolidation of maybe some of the market participants that had raised capital around for farmland investments around the cheap monetary policy. And just using like an Iowa, Illinois type of an example, where our 20-year appreciation rate for farmland has been in that 7 to 8% range, and your cash yields have been in that 2.5% range. You're looking at a total return of 9 to 10% for farmland. And so when your cost of capital was effectively free, that was a pretty easy value proposition to go raise money around and convince people that they should invest in farmland. And, a little bit of what I'm seeing now is it's getting more challenging to raise capital and leverage costs more. It's hard to add leverage on a farm that's returning a 2.5% return, and you're paying 7 to 7.5% for your capital, and that price of capital now matches your appreciation rate. So you need your 7 to 8% appreciation rate just to hold your money together to justify putting leverage in place. And so I do think there's a reshuffling of the deck in terms of who maybe some of the buyers are, and some of those buyers that raised capital around cheap monetary policy. I think that's going to be a tough business model, because I don't think cheap monetary policy is coming back into play. But what we're seeing in some of the phone calls that we're fielding in the office right now is there is a new class of buyer emerging, and there's a lot of like this super high net worth family office, foreign capital that has this belief that inflation is going to be persistent and it is going to be here for the long haul. And it's raw cash. It's not leveraged cash that's looking at farmland as the best, worst place to put their money for this inflation protection. And so it's interesting. There's a little musical chairs going on where some of that cheap quantitative easing capital is exiting the farmland space, And then you've got some new capital that's looking at farmland purely for the inflation protection and not using leverage at all. And of course, on the farmer side of that ledger, you've got some of these farm families with generational wealth that aren't using leverage either. But then you've got expansion-minded farmers who do need to use leverage. And I do think that's where you see a little disconnect in the farmland market, where if you're in a community where you've got that generational wealth, where they're going to stroke the check and buy the farm regardless of what it sells for and regardless of what the cost of capital is, those types of transactions, you're still seeing those super strong land prices. Whereas if you're in a neighborhood where you're relying on somebody who needs to borrow money to facilitate acquiring that transaction, you fundamentally need to buy that asset at a lower price today than you maybe did a few years ago when your cost of capital is about half of what it is today. And I think that's where you're seeing different results on different farm sales based on who your buyer is.
That's a great point. I'll not add anything material to it except to say that if you think about it, since 2008 till today, less than half of that time we've been in a normal monetary environment where you could look at the cost of capital as not being influenced by a Fed monetary expansion regime. The point is, making those rational comparisons to capital that's competitively allocated across things that included debt, those business models have really only existed for about half the time for the last 16 years. We've been in a very strange period of time. Think about, we sort of joke about this, think about trying to teach time value of money to students who have never had a positive savings rate in their life, their semi-adult life. So we don't have kind of long-standing, easy to look at markets where we can say, hey, the real effect of the cost of capital in agriculture moving up 2 basis points is this amount on land. The markets have been a whole bunch of individual year case studies.
Yeah, and in fact, though, I do think that the land market perhaps is more rational today than at any time I've seen it in my 21-year career in the farmland space. And when I look at those cap rates, like land values have softened, and yet your cap rates have not increased. But your entry level into the farm is at a more rational level today. A farm that was maybe 18,000 an acre a year ago might be, 16,000 an acre today. And yes, your return on your cash yield's not higher, but your entry level into that asset's at a lower level, and it's more rational. And when you think about the folks that are looking at fixed income and saying, hey, I can go get a T-bill for 4.5 or 5 or put it in the money market account, there is no inflation protection there. And so some of the same things that are driving Bitcoin and other alternative investments, when you look at farmland and you look at that long-term historical appreciation rate combined with that lower cash yield, that some of the capital that's maybe jumping out of farmland right now, they're really doing it at a time when it perhaps is one of the best times to be jumping into farmland for that inflation protection and the non-correlation with other assets. Yeah, it's more of a statement than a question, I guess.
True. I forget who we heard it first from, but the time to buy farmland is when it's for sale. Again, one of those quotes I wish I had been the original source of. But if you're looking at something that you want to hold for 50 years, either in a family preservation of wealth system, or the Mormon Church is a very large landowner and large land buyer, and then the mistake you make on the way in begins to get diluted pretty quickly if that long-term thesis is true. And the long-term thesis continues to include the effect of growing populations, growing quality of diets around the world, and we are really good at forecasting populations. And we're not quite as good at forecasting longevity and so on. But, 5 of the 10 largest countries will be in Western Africa by the time 2100 hits. And to be blunt, you're going to have to import a lot of food. And so this question of where you get enough to sell to that is going to, part of the answer is going to be the middle of the country in the US and the coasts. So getting to 20 or 30 or 50 years from now, you might actually have to start now, was the point. And so again, I think the other thing supporting those values is one farm is almost never the right scale to buy anymore. You don't have people going from I'm not a farmer to I'm a farmer. I'm just going to buy a farm and become a farmer. The commercially viable scale of farming, I always tell students, is whatever the number of acres one class 8 or 9 combine can get over in a year. It's kind of defined by that scale now. And so the accumulation to that quantity is not something you can do if you don't occasionally overpay because something's for sale.
One thing I wanted to hit on. So many of the things when we're talking about land values and you're getting your crystal ball out and trying to make a theory on where you think the land market's headed, and I think that's what we're doing here with our National Land Values Report, is laying out all the different things that are issues around the Farm Bill and trade and labor. And even this week where the Fed lowered interest rates 25 basis points. And the first of the week, it looked like Congress may pass a resolution that included $31 billion for farm producers. And then Elon sends a text out or a tweet out and immediately kills the $31 billion bill. But when I saw that package and I saw interest rates going down, I'm thinking, let's go buy more farmland, because the farmland market is going to go up. Farmers are going to get payments in their pocket. And then that quickly went away. And I think that plays into a little bit of the environment that we're in. It's really hard to make any predictions with all the geopolitical uncertainty in the world and the new administration and the Farm Bill. And so I think, if we can all give our closing thoughts on what we think the farmland market's going to do in 2025, and I'm largely going to say that the market is going to continue to show a little softness in 2025, not to the degree that maybe many people think that it should. And it really comes down to the fact that there's such low turnover, there's such low leverage, and then there's so much capital that still looks at farmland as a place to store generational wealth, and it's an inflation protection asset. And I'm convinced that, as you said, Bruce, the best cure for low prices are high prices, and high prices are low prices. I think U.S. Commodities are relatively cheap on a global scale right now, and there will be some weather event, some geopolitical event, some sort of government intervention that is a bullish factor for agriculture and farmland in 2025. And I think while the market's going to recalibrate to the new cost of capital that I think we're all accepting is not going to probably go back to where it was, I think you'll see that slow unwind where those return expectations to put your capital in the farmland might slowly increase from 2.5 to say 3 in the Midwest. But that doesn't happen overnight. It doesn't reprice like the stock market. And that's where I think you'll see some buffering in terms of how the market unwinds. And so I think you'll see a little softness in 2025, but I don't think it'll be to the degree that one might think. And so that's my view, but would love for you guys to give your 2025 view.
Dave, go ahead.
Bruce, you go first. So, generally agree, Steve. And I also sort of put on that it's going to feel just a little bit chaotic too, right? There's going to be, it's going to be hard to get your arms completely wrapped around what you're seeing and how that plays out. And as we bounce around the country, we can see different production systems that are at different cycles in their, high and low prices, fixing high and low prices kinds of dynamics. Where we're going to have some opportunities, and we're still going to feel a little bit cautious about different sorts of outcomes, right? We've seen some movement in tree nut prices in California, as an example. We're still seeing some significant pressures in the tree fruit space up in the Pacific Northwest, right? And you can start to move around the country and just find some of those pressures that are tugging in different directions to where it does feel like we're kind of in for a 2025 where things are moving around in a non-uniform kind of way. And we're going to have to dig deep to figure out how we feel about different production systems in different regions. Generally speaking, I would say that you do feel the conditions for a little bit more correction, and then you just can sort of plan on farmland across different regions and different systems needing to be looked at a little bit more independently. There's not a sort of large kind of uniform push towards value add the way that you can potentially see it. We have seen it at other times.
Echoing all of that and the theme of the widest confidence interval we've ever had. In other words, predicting is harder now than it's ever been. I wouldn't be surprised to see a little bit of a pullback, but I think the pullback will still need to be precipitated by some policy or macro or world event that is not present now. Otherwise, I would expect to see essentially flat or even the amount of like what I think of as the equivalent of limit orders that are kind of waiting to come to the market, I think is hard to overstate. There's a lot of folks who would like to own farmland still. So I'm not expecting a huge correction. Again, if we have tariffs, that can be really problematic for prices. And if we have reduction of government spending on farm programs, which by the way has never ever happened, but there's been a lot of effort to rein in spending. Perhaps if you have those events, then it's going to register at least short term as you're indicating. But I'm not expecting major fallout or breakthroughs to the downside.
That all makes sense. I think Dave's comment that not all farmland is created equal is quite interesting, and that's been an observation too over the last year. As you've looked at how farmland's behaved in different regions, you do have these regional effects, and one of the things that the National Land Values Report does a great job of is breaking it down by region: irrigated, non-irrigated, permanent crop, row crop, cash yield, and appreciation. And so for everybody listening to this call, it's pretty interesting to really see those regional differences in how farmland performs. And one thing, as you talk about farmland as an inflation hedge, I think a lot of people broadly applied that to all types of farmland. And I think one of the things we're seeing in permanent crops is that it's almost the exact opposite. You've got depreciable assets, you've got increased labor cost, replacement cost for irrigation systems are subject to the inflation issues that we're facing. And so I think a lot of people take some of the farmland inflation correlations and they apply it universally to all farmland. And I don't think you can do that. And so when you do read through the report, I think some of those things will show up and shine for folks. I think I want to close this out. Like Bruce and Dave said, appreciate everybody being on the call, and we will get the report emailed out to everybody, and that'll be available to download on the People's Company website as well. And we'll have hard copies of the National Land Values Report available at the Land Expo here in January. And Bruce will be doing a breakout session where he'll go deeper into some of this as well during the Land Investment Expo. So a plug for the Land Expo. This will be our 18th year of hosting the event. Incredibly excited about the program that we've put together this year. We've got a great set of keynote speakers. Mark Brinkmeyer is the CEO and owner of Idaho Forest Group, and he's going to talk about the timber industry, and that's something that we didn't get into today. But there's a lot of things happening in timber right now that I think fit into some of the themes that we talked about around ecosystem services and carbon, and so Mark will bring some interesting insight as well to that. Richard Bogg is a retired banker and a futurist type of thinker that we're excited to have on the program. I had an opportunity to go meet with Joe Lonsdale this week down in Austin. Joe's an entrepreneur that started several billion-dollar companies at a pretty young age, and 8BC and Planetaire, a couple of the companies that Joe started, and has a company that invests in alternative investments and takes those mainstream to registered investment advisors. And so I think he's going to have some interesting thoughts on how farmland could fit into people's investment portfolios. Kyle Bass with Conservation Equity. He's a China expert as well. And Kyle and I had a chance to talk last week, and we're excited to hear his thoughts on on alternative investments, on geopolitical issues, and on the farmland markets. Steve Eisman was on the program several years ago. Steve was featured in the movie The Big Short several years ago and predicted the 2008 housing bubble, and excited to get Steve's views on the economy and inflation and interest rates. And then Cliff Kupchin is the chairman of the Eurasia Group, Ian Bramer's group, and will be talking about geopolitical issues as well. So encourage everybody to get signed up for the Land Expo. We have both a virtual and in-person option if you can't make it to Iowa on the 14th of January. And with that, Dave or Bruce, do you guys have any closing thoughts or things you want to say before we let everybody go?
Just thanks for everyone's attention. I know we kept you a little longer than intended. Appreciate it. And again, call us, email us, send us courier pigeons if you want. We love to talk about this stuff. And if there are any things we can do, if there's anything we can do to keep the information flowing, let us know.
Yes, thanks
Courier
everybody.
pigeons.
This is
Like that,
always a
Bruce.
fun project.
Thank you, guys.